Hi, it's Chris Titley here. As part of the Deep Dive series, I'm joined by Ethan Singer, co-founder of Fundabl. Ethan, thanks so much for being part of the series.
So great to be here. Thanks for having me, Chris.
Ethan, Fundabl, let's talk about, I can see it in the background, the logo. What is it and how did it begin? Oh, and on the t-shirt
Yes.
as well.
So effectively, we offer businesses quick, short-term, non-dilutive capital. How we do that is we will provide businesses up to 12 months of their predictable revenue streams upfront at a fixed discount. So generally, we're supporting businesses with additional working capital, whether that be to accelerate growth or marketing or business development efforts or products, as a runway extension, or as a complementary to an equity raise to avoid the greater dilution, or to avoid being able to offer clients a hefty discount to incentivize upfront pay. Because the closest product to us is just the fixed discounts. And there's a lot of businesses that would like to get their clients to be paying yearly in advance because the additional working capital to the business allows them to provides a lot of growth opportunity or ability to not need to dilute or to scale the business. So we allow businesses to get exactly that, which is up to 12 months of their predictable revenues up front, but on much more attractive terms. How the business came about was I sat on the other side of the table. I was investing equity into business as part of a venture capital wing to the business. And I felt there had to be a more founder-friendly offering out there that rewards businesses that are doing nicely and just want to kick things on a little bit longer and not yet dilute or dilute as much, or be able to incrementally swap out of contracts or revenue streams as they come through to be able to accelerate their growth.
And Ethan, how did the business begin in terms of its inception and then I suppose going full time and being an incorporated company ready to take on customers?
Yeah, so I initially thought of the idea early 2021, and it was a good 5-6 months of validating the idea, speaking to other financial people in offering other financial products in the markets. I eventually connected with my co-founder in September last year. He was previously at a non-bank lender, David Salkinder, and we got to know each other, loved each other, the company, believed in the mission, the vision, and the idea of being able to support businesses throughout their growth journey. And we came together full time in September last year. We then raised some initial seed capital just after Christmas. And since then, we've begun to onboard clients, and we've got a really nice portfolio of clients from growing bootstrap startups to much larger, well-established, profitable businesses. And it's been very rewarding being able to see some of the early success stories of some of those clients taking our capital.
Yeah, no, and Ethan, in terms of market awareness and the types of capital or funding, sorry, that startups and emerging technologies can get, I mean, traditional is equity with either venture capital or strategic investors, etc. The idea that founders have an alternative source. Can you talk about the education process and the hand-holding process there is for founders out there and founding groups that want to get to know you and maybe a little bit gun shy?
Yeah, definitely. I think to that exact point, Chris, there's definitely an educational piece around alternative funding offerings. I think it's becoming a bit more prevalent, particularly in the current funding market, where there's no secret that the pace of funding is slowed. There's smaller funding rounds and perhaps a steeper climb to close. And I think previously the all equity route was a signal of, I guess, success, and more so the more successful founders are those that are being able to hold on to their equity and be able to grow revenues, I guess, through organically or through alternative funding offerings.
And Ethan, how long does a business need to be operating, I suppose, before they come to you? And is there some sort of minimum metrics that you look at, and how do you go about doing your DD before you provide that funding?
Yeah, so we require businesses, they must have an Australian entity, and they need to have at least 15K of monthly predictable revenues. Um, to onboard with us is incredibly quick, generally within the week, sometimes within 24 hours. We've onboarded many clients within 24 hours, and all we require is three pieces of onboarding information. We require read-only access to their accounting software, whether that be their Xero, 12 months of bank statements, and a summary of the current clients on foot. So the onboarding process is sub 3 minutes. And from there, it's a pretty quick steer as to the level of funding and the cost of capital that we can provide to supports.
And then in regards to the payback period or the interest rate and how you guys sort of make money alongside the startups, can you talk me through a sort of a 101 customer that onboards with you and sort of everyone wins?
Yeah, definitely. So the term is up to 12 months. So we'll provide capital up to 12 months. More recently, we've seen a lot of clients taking very short-term bridge funding of perhaps 6 or 9 month capital, whether that be to have a little bit more of a runway extension to be able to close out a capital raise or get to an R&D grant, or to be able to take on some larger contracts or to scale product development or business development efforts. And yeah, we've had some really great success stories even in these early days. We've had clients that have been able to get through capital raises, improve their negotiation power when they do speak to other capital providers. We had one client that took our capital and within 45 days doubled their revenues. They took our capital and launched into the States, which was very exciting. So yeah, we've had some really great success stories from clients taking our capital.
And the feedback that you've got from some of the clients in regards to the onboarding and the process, and also the hand-holding through that period and the payback periods, etc. How are you going in terms of your own product innovation and also the taking that feedback and potentially using that to drive your business?
Yeah, definitely. So I guess we've expanded into we're serving a whole range of various clients. So initially we were very focused on businesses that had a recurring revenue stream. We've supported businesses with all various pricing models. So initially we were looking at businesses that only had pure MRR, call it. Now we've supported businesses that with various ranges in pricing models, whether that be professional services, transactional revenue, usage-based pricing. All we require is some form of consistency, predictability to their revenue stream, and we will be able to support. So that's definitely been, we've obviously, in terms of the feedback that we've gotten from clients and some of those that have wanted to take our offering but wouldn't have otherwise been able to do so because they didn't have pure MRR. Now we can cater to that clientele, to those clientele, and so we've broadened our reach.
Fantastic. And in terms of your own business and yourself, you've been around for about a year, I think you said, in terms of being in market and whatnot. I mean, the progress thus far, are you happy with where things are at with your business and the team and the people behind the brand?
Yeah, it's been quite the journey. Exactly. We've been in operations just over a year now. We've built a really nice portfolio of clients that are all growing and using our capital and incrementally growing. And we're very focused on building long-term partnerships with our clients. We're very focused on being able to help them throughout their growth journey. So how our model really works is, as our clients grow, we hope that we can increase the facility that we can make available to their clients, and we can continue to grow with them as those need arises. So yeah, it's been an amazing journey. We've got an amazing team. We're building out a lot. We're building through our processes. We've built out our tech to begin digitally onboarding clients, which has been well received from our existing and bring on clients coming on to the platform. And yeah, it's been very exciting.
And Ethan, moving forward and putting the hat on to the next little while, the next period, I mean, we've gone through a fairly turbulent time when it comes to as you mentioned before, the funding side of things. I mean, as you mentioned, venture capital funding has dried up a little bit, particularly in fintechs, etc. What are the plans over the next little while to grow the business and to make yourselves more aware to fintechs and other businesses out there?
Yeah, definitely. So one of our main priorities at the moment is onboarding more clients. So there definitely comes an educational piece to that, to my previous point, Chris, in terms of educating clients around alternative funding offerings to help to support businesses throughout their growth journey. So we're very focused on onboarding new clients, as well as putting our name more out there, having events, co-hosting events, going to ecosystem catch-ups, and really getting our name out there as a funding offering that supports businesses throughout their growth journey.
And when it comes to funding offerings, people will automatically think of maybe a loan through a bank, etc. But some of these businesses mightn't pass through that criteria. Can you talk about the average funding size that you guys do as a sort of a rule of thumb, and how that's moving around in these conditions?
Yeah, so the average funding size, our typical advance is circa 250 to 750K. We've done mil pluses, we've done as small as 50K, but I'd say our sweet spot advance is within that 250 to 750K. We can also cater to clients that are looking for around the $5 to $10 million range as well. And we use and we've got means to do that as well through other mechanisms. But our typical sort of sweet spot is around that 250 to 750K. And during the current environment, we've found that businesses are looking to utilize more of our capital. The benefit of our capital is it's literally just the fixed cost. And each incremental dollar that they draw down, they know that they can put that to higher and better use. And whether that's growing revenue or being able to avoid or increase their runway, or to not raise as much equity to avoid the greater dilution, clients are using our product much more often.
Yeah, just on that point, in terms of the use of funds, do you get a good understanding of where clients might use your product, and maybe that's sort of the messaging from them is coming a bit closer to you in regards to where you can find a sweet spot, and whether it be a softer period, whether it be a bridging gap through to funding, or through a funding period per se? I mean, there's lots of different little angles there, but is there one sort of emerging that's coming through, or even potentially, as you said, enter into new markets?
Yeah, no, you're spot on, Chris. I'd say the most prevalent use case, particularly at the moment, is a bridge funding use, whether that be bridging to a capital raise, or bridging to new revenues coming into the business, or to an R&D grant, or to new clients coming on board, or tech being developed. As a bridge funding solution, I'd say would be the most prevalent use at the moment. We do have other use cases, of course, as a complementary to an equity raise, just general additional working capital to be able to scale product or business development efforts. We've had a few clients, not as prevalent, but a few clients that have effectively turned off their annual upfront option in order to, and rather used us as the means to be getting annual in advance, because the discount that they were previously offering was within that, was much higher than the rates that we're offering. And also there's additional benefits to taking our capital, in the sense that it doesn't condition clients to only accept your product when a discount's being offered. It's an always on option for the business to be able to choose which clients they would like to bring 12 months in advance. Top line revenue isn't affected, which dresses up your valuation from a multiple perspective. So there's a few other benefits there, but that's also been one of the use cases. But the most prevalent one has been as a bridge funding solution.
Excellent. And Ethan, if you've got some startups there, or emerging technology companies, or even other traditional based companies out there, and they've never heard of Fundabl, how do they reach out, mate? What do they do? What's the process? And whereabouts are you based, et cetera, and the team to kind of look after you?
Yeah, definitely. So the easiest way is to onboard with us, and you can see probably in
Oh, there's a
in
little
my
QR code there.
there's a little QR code, and they'll
Very
head
cheeky.
straight to our onboarding form, which is very easy. And from there, it's a 2 to 3 minute onboarding process to provide a quick steer as to how we can support. Otherwise, head to our website, www.fundabl.com. Can also reach out to me directly, ethan@fundabl.com. Would love to connect and explore how we can support your growth journey. We're based in Sydney, in the CBD, so you can always come to our offices as well.
Ethan, thanks so much, mate, for giving us an understanding of Fundabl, the history of the business, the positioning that you're entering into within the Australian ecosystem, and how you're supporting founders along the journey with alternative funding, which may not be as known in the market right now, but certainly getting some traction and helping them through some reasonably uncertain times. Look forward to catching up, and thanks so much for being part of this deep dive series.
So good. Thanks so much for having me, Chris. It's good fun.